Despite the blast that hit the north, delayed elections finally taking place over the weekend in Nigeria. And at this stage, reports we're seeing saying that the ruling party looks set to be losing its grip on parliament. To what extent is this coming as a surprise to the markets?
Hi, Alicia. I think it's a little bit premature to say that the ruling party is losing its grip, as it were. A big part of what we're seeing is stuff that we pretty much expected, which was that they would probably retain power in the center and lose some seats here and there. Overall, I think the elections have come like we're all expecting and seem to have gone relatively peacefully and sort of according to expectations.
Where to from here on out? How are you reading, the kind of temperament that's on the ground right now, and how a verdict, the final verdict, is to be accepted whichever way it swings?
I mean, I think this is obviously, without overstressing the point, a very pivotal point in Nigeria's history, or Nigeria's fair, as it were. So obviously, it's a very, very important and critical election with so much at stake. Overall, though, I think we can say that most parties have sort of stuck to the tempo of the game, and it's an election that seems to relatively come peacefully, and looks like everyone will stick to the rules, as it were.
What's your view then on market activity from here on out? Because through the first quarter, the performance has been pretty mixed, and many anticipating that it's going to be much of the same heading into the second quarter.
Well, I mean, if we take a step back and just look at what we've seen in the markets this year, in January we saw a huge rally, as we all know. February, March, things sort of tempered down a little bit to the point where we went from being up about 12% to relatively flat on the year now. And the question is, what really happened? The answer is, in our view, is the whole political or election premium on the market, that whole uncertainty. If we also take a step back, compare our markets to international markets, you'll find out that in January, when we were, sort of having a good time, in quote, markets everywhere else, for the most part, were suffering. We've seen a reversal in that now, where most markets everywhere, you can see a lot of risk-taking activity, which sort of is supporting most markets. Here, on the other hand, the whole election sort of overhang seems to hold on us in some sense. The implication of that is simple, is the market is expecting the elections to come. Hopefully they come peacefully like we're all expecting, and I think the market should rally from there.
Let's get a bit company specific. Dangote Cement reporting an improvement in full year results. PAT up 125%. We saw earnings per share up 74%, while turnover rose 56%, and that company declaring a dividend of 2.25 naira. Your overall impressions of those numbers?
We saw some very good numbers from Dangote, just like you said. We saw some strong double-digit growth, top line, and even the income figures, very good. Two sort of things that sort of spoofed the market a little bit. Those figures, as good as they were some 10% below the company's, sort of numbers that they give us an idea would be coming out. That's one. The dividend yield, on the other hand, as well, seemed to be relatively lower than the market expectations. But overall, I think those figures are impressive and sort of set the tempo for hopefully improved growth in the company, obviously based on how the overall economy performs.
Looking at that divvy payout ratio, though, at 62%, falling somewhat short of the 75% that had been guided by management. To what extent did that present some disappointment?
I mean, on the surface of it, it's, it's like I said, it's not what the market was expecting. We're all waiting for sort of the company's guidance, on what really accounted for that. A big play on Dangote, why a lot of us went into it, was obviously the dividend payout ratio, a very high dividend payout ratio expectation. So we'll just hopefully look forward to management giving us some color on that.
Some of the key risks that remain there, Temi, is the delay in commissioning of its increased capacity and those systems coming online, disruption of fuel supply as well. To what extent are you factoring in those risks?
Well, I mean, yeah, you've mentioned two risks there. One is fuel supply, and one is sort of the plants coming on stream. Ibesha, for example, was supposed to come on February 2011. Now we're looking forward to June 2011 for that to be commissioned. So that's one risk on one hand. To sort of balance that, you look at the fact that, say, LPF, or low power fuel oil that they use in their plant in Boko, for example, prices on that have been relatively stable. You look at the Albajana plant, for example, where they use gas, primarily. That's been pretty much, as a matter of fact, is one of the things that we think attributed to some of their high margins this year. So sort of those risk balance out in our view, we look for more color on that from the company as well.
In the meantime, we had full year numbers come through from Mobil Oil Nigeria as well. Revenues down close enough to 6%, but we had profit before tax up by an impressive 40% and pre-tax margins also improving close enough to 10%. What did you make of those numbers?
Well, with Mobil's numbers, you had to drill in a little bit more to get more color on that, on those figures. If you look at the first 6 months, if you look at the top line figures, first 6 months of 2010, their sales was on the order of about 32 billion naira. July to December, it declined about 17–18% to 26 billion. A big reason for that is because in April of last year, the government obviously sort of accelerated their time frame for reimbursing for the subsidies, for the marketers. What that did was brought in a lot of independent, oil marketers into that space, since the space was sort of de-risked in some sense. So that wasn't very good for firms like Mobil. To counter that, looking deeper a little bit more, you find that Mobil, sort of to compensate for that, is expanding aggressively into deregulated other spaces such as lubes. You get more margins from that sort of space.
Well, we've got management feedback also suggesting, with that diversification strategy aside, that we've got performance being enhanced by efficiency drives, also that it will continue to source its products from some of the cheapest available sources. Do you see this being enough to sustain and then grow this performance from here on out?
I mean, if done properly, absolutely, it can sustain the company. Diversification, like the management has said, is key. Right now, about 90% of their business sort of depends on PMS, which is this space that we're talking about is getting overchoked, getting a lot of new entrants into the space. If they can properly diversify out of that space, like I said, into things like lubes and other higher margin type products, the company should come out pretty strong.